Hello folks, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital. Today's topic is on the bond market. Are the credit markets sending us a warning signal? Right, and the real key to today's video is that what we're really talking about is the screaming sound of silence. What the hell does that mean? Well, you'll understand when we go through. But I think the bond market is screaming right now by not saying a word. All right, jump right into this. Here we're looking at investment grade and high yield spreads. All right, so high yield is currently paying 600 over treasuries, while investment grade is paying 140 over. Right? A big difference between the two. That's not what I'm talking about though. Notice for the last 6 weeks, month and a half here, this thing's been trading fairly flat. All right, now why is that surprising? Well, we got a number of things going on, but the biggest thing is, of course, the run up in equities. I mean, these mind-boggling equity returns. When equities do well, credit normally does well, and yet credit's trading flat. What's going on there? That's a hard one to figure out. So let's drill down into the investment grade thing. We got 4 classes of investment grade, right? The lowest is triple Bs. Triple Bs are paying 190 over. All right, the spread is 190 over treasuries for triple Bs. A rated is 110 over. Double A rated is 80 over, and then I don't show triple A rated here because there's only 2 triple A rated companies left in the U.S. All right, so we can see the same thing here. The spreads have been flat for the last 6 weeks in all these different categories. Now, what's amazing, what I want to focus on here is the triple Bs. The fact that we're not seeing this bad boy start heading north. Now, we talked about this many times. At some point, I think we're going to have this wave of downgrades. Credit downgrades like we've never seen before. Now what I'm talking about is during the most recent up market, we had companies taking out more and more leverage and financing the stock buyback programs. You know, the regulars will know that certainly will dill your pickle, or certainly dills my pickle when we talk about these stock buyback programs. But companies were taking on debt and using it to buy back stock. Now these increased debt levels meant the credit ratings kept coming down. So now we have this ton of triple B rated companies in the U.S. and throughout the world. All right. And now within triple B, of course, there's triple B positive, triple B neutral, and triple B negative. And the triple B negative then are the ones that are most likely to be downgraded. Well, just this past week, there was an interesting Bloomberg article where they noted that of the triple B negative companies in Europe, one third are now in negative watch. All right, so that's how the rating agencies tend to do it. They do it in a series of steps. So we've had this massive stimulus program that has slowed down this tsunami of downgrades that I've been talking about, but it keeps coming. It's not going away. You just can't print money and generate economic growth. Right, and so the credit downgrades, the negative watches, negative outlooks continue to grow. 1/3 of all European triple Bs are now on negative watch. That's amazing. I didn't see similar numbers to the U.S., but I got to imagine they're comparable. Are we seeing this in the spreads here? Again, go back to the triple B spreads. Triple B spreads aren't reflecting any of that. What's going on here? Wow, that's a tough one. That seems to be huge tail risk. Before we explore that in more detail, though, that was the investment grade side. Let's look at high yield. Let's look at what's going on in high yield. Again, it was paying. You remember the overall composite here is paying 6% over. Well, if we just look at the energy portion of high yield, that's paying almost 9.5% over. All right, much higher than the composite. And then, of course, high yield, if we pull out the energy, is only paying 5.5% over. All right. So again, energy is really what's dominating these higher returns that we're getting in the high yield sector. But for the most part, flat, right? Again, flat everywhere. High yield is not confirming the equity rally. Investment grade is not confirming the equity rally. All right, that's on the one hand. On the other hand, this likely downgrade, massive number of downgrades are not being reflected either, though. So let's go one last step. One last chart I want to show you today is we go down into high yield. All right, and the highest category in high yield are the double Bs, and they're paying 4.3% over. The single Bs are 6.1% over, and the triple Cs are 11.7%. Right, that's where you really make your money. Those that are on death's door. If you're willing to invest in these, that gives you your highest rate of return. All right. So what we can see here as we look across is very similar to the previous conclusions, right? For the double Bs and single Bs, flat. Even though equities are rallying, these are fairly flat. Some of the triple Cs are starting to tick up. The spreads are starting to widen a little bit, but still not much. All right, so what do we do with all this information? I said I think the bond market right now, the credit market, is screaming in the sound of silence. Not that I'm a word maven by any means. What I'm talking about here is we've had this tremendous equity rally that credit is no longer confirming. And the reason for that is because the downward pressure of these the credit downgrades are offsetting that. So on net, the good news and the bad news are being canceled out. For the most part, spreads have been flat. So it looks like the high yield market's telling you nothing, but in fact, I think the high yield market is telling you a hell of a lot, right? The credit risks are going straight up. That's a huge concern. But the risk appetite, the offset to that, is what's keeping spreads in line. All right. So not only are equities going up, but within high yield, remember the Fed has your back right now. The Fed's even buying some of the high yield bonds. They're certainly buying the hell out of the investment grade bonds. So the Fed has your back. Right? That's the good news. The equity market, the Fed. The bad news, though, exactly offsets that. Wow. How could something not move and be so damn interesting right now? Only the fat man can come up with this shit, people. All right, so that's our message for today, boys and girls. You just experienced a rich insight, and I hope you've enjoyed this. May your beer be colder than the company you keep. We'll talk again soon. Thank you.